Out there are multiple investment options. People do often get confused on where to invest because multiple options are provided based on the appetite for a person they have for their investment. The higher the risk, the greater the profit. Based on this, there are four major investment asset classes. One should choose wisely based on their risk taking ability. I'd like to introduce you to the first asset class, fixed instrument. This is the low risk asset class that gives moderate to better returns based on the risk that you are ready to take. Ah, wait. What did I say? Risk in fixed instrument? Yes, you heard it right. The risk associated with fixed instruments also. Let's take a look at it one by one. The first one is the very well known bank FD. Do you know the risk associated with the bank? It's the closure or collapse happened in the Lehman Brothers collapse in around 2008. The bank goes bankrupt, but the government is backing it up so the investors can be sure of a minimum money to be returned in case of a bank crash. To compare the returns from the various banks, we have a Policy Bazaar page which will help or give us an idea on the bank rate FDs for a comparison. I'll take you to that. It need not be accurate, but just for comparison. Better to go back to the bank link directly and confirm the FD returns percentage. With this instrument or the asset class, one can get a constant income, but for a short time. Post that, the bank interest rates will change, and one has to constantly keep watching on this. Sometimes special offer gives more returns, so be watchful about it. The next one is a GSEC or the T-bills. This is far more secure because this is the government paying the interest directly for their development process. Government bonds and T-bills can be found in the RBI website. Let me go to the site and so this is the site itself. And look for the tender-wise indicative yields here. Yes, you have a tender bucket that talks about the period of investment and YTM called as yield percentage on the right. This itself is a separate topic and I'll try to see if I can cover later in some other video based on your ask and subscription counts. The next one is my favorite, the private debentures. This is the loan for the company directly. This is riskier, but at the same time you get higher yields too. I will quickly take you to the website to explain or see like what are all available and what are all the rate of returns and what is the risk associated with it. Yes, this is the web page itself, and in that I click on the active deals. Here you can see the return is giving a 14.4%. Wow. Wait, don't jump in. We are not yet there. It has a maturity till 2029. So for the next 4 years, you can get interest paid. And the minimum investment amount is also a criteria. You can see the credit rating and the interest distribution timeline on the right side. This company pays you a monthly interest. Okay. Again, I'm introducing you to the various options available. You need to deep dive into that to understand more and talk to your financial advisor before you could invest to know about the risk and the taxation part. Right? Just hold on tight, baby. We are going to dive into the next asset called equities. Investment in equities involves buying shares of publicly listed companies. The shares are traded on the Bombay Stock Exchange called BSE and the National Stock Exchange called NSE, where an investor invests in equity. Unlike a fixed income instrument, there is no capital guarantee. However, as a trade-off, the returns from the equity investment can be much better. Indian equities have generated upwards of 12% CAGR, that is the compound annual growth rate, which we talked about in the previous videos. Over the past 10 to 15 years, this has been the case. Investing in some of the best and the well-known Indian companies has yielded over 20% CAGR in the long term. Identifying such investment opportunities requires the skill, hard work, and patience. If you're not willing to give that, could opt for mutual funds where there are dedicated fund managers. You pay them to manage your portfolio. This is an ocean. To dive deep into it, I need more motivation and encouragement. Let me see if you are excited to learn about stock market investing the way I put forward. Show it in the form of likes, comments, and subscriptions. Okay, but a word of caution. Again, there are a lot of scams going on with related to stock market. Please be careful about it. Don't fall for the false promises they make about guaranteed income in the stock market. The next instrument I'm going to talk about is the real estate. The real estate investments involves buying and selling of commercial and non-commercial properties like vacant land, apartments, and commercial buildings. Incomes comes from rental earnings, typically 3 to 4 percentage, and the property value appreciation is the other part, which varies by location. Transactions can be complex due to legal checks, and the investments require substantial capital. Since there is no standard metric to measure the returns, evaluating the profitability can be a little challenging. Also, the real estate differs from place to place, and hence, a good amount of work and study will lead to a good investment. This is also requiring a similar amount of effort you put for the equities, except for the real estates has lesser liquidity. Also, for any property registration and deals, you may have to be present there physically. You may have to wait till you get a buyer. So, if you need to liquidate the asset, you need patience and you may have to go through a lot of commissions also. So, the next instrument we are going to talk about is the commodities. As an investment option, gold and silver are popular investment options that have appreciated over time. With annual returns of 5 to 8 percentage over the past 20 years, investors can choose from physical gold like jewelry, gold coins, or bars, or ETFs, or sovereign gold bonds. This year, gold has given a very good return, but in my view, it is a shock absorber, a commodity that continued to rise only as the inflation grows. Gold prices also grow. So it's a solid investment against inflation. But at times it can give a very good profit also. So by now, hope you should have got an insight on where to invest and the returns that you can expect in the various asset classes. As I mentioned in the beginning of the video, based on your risk appetite, you can choose where you invest and how to retire. If you haven't seen my video on how much you need to retire without losing the lifestyle, please check out the video in the description. We'll catch you soon in the next video. Thank you for watching.